Today's video I'm going to cover, the topic is going to be compounding growth. Something I mentioned about a month ago on my very first video, the power of compounding growth, how important it is, especially for younger investors, to realize and then accelerate their compounding over time. I'm going to show you a couple of really cool charts, a great website that I've shown not only clients that I've worked with, but also family members, myself included. I've used this tool for a number of years. So sit tight. If you like what you see, again, click that like down below and the subscribe button. I have plenty more videos coming out for you here in the future. Again, the Rational Millennial, we're going to the moon. This is the tool that I wanted to show everyone today. Again, this is going to be a short video. I'm really just going to go into some of the ins and outs of what compounding interest really, first off, what it is, but second off, what it can do for your portfolio over time, right? So simple search here, just look up the straight definition of it. Compounding interest is the addition of interest to the principal or sum of a loan or deposit. In other words, interest on interest. It is the result of reinvesting interest rather than paying it out, so that interest in the next period is then earned on the principal sum plus the previously accumulated interest. So all that really is saying is if you have $5,000 and you grow 10%, your balance will be $5,500. If you grow 10% again the following year, you didn't grow, that money didn't grow on 5,000, that 10% grew on 5,500. So it was even bigger. But this is what I wanted to show people. So for any younger investors out there, I know everybody wants to talk about high flyer stocks, things going to the moon. I love that too. Don't get me wrong. Everybody loves when you hit a home run, you threw 5,000 in a stock, and all of a sudden, you check it a couple of months later and you're looking at your balance and it's $30,000. Sure, we all love it, but unfortunately, that doesn't happen very often. Actually, the odds of that happening are probably lower than you getting a full scholarship to play a Division I sport. So let's just be honest with ourselves. Again, I'm going to start really small here. I'm going to start with $5,000. I'm using a perfect example of myself. I started my investment portfolio with $5,000 in 2013. Okay. Monthly contribution. This is what I really want to get at. So there's a saying at an old firm of mine that I worked for. They called it time in the market. Time in the market, not timing the market. So everybody wants to time the market, right? What's this stock trading at? $4 right now? Nah, I'll wait till it gets to $3 and then I'll buy it. Oh, it's trading at 30? Nah, I'll wait till it pulls back to 25 and then I'm gonna buy it. The idea of timing the market is very important when you're a very sophisticated investor or an institutional investor who's trading, 20 million shares at a clip, or you're gonna buy 2 million shares. And the difference between, trading at $10 versus $9.50 is a huge dollar figure difference, right? If you're trading a couple million shares and you can buy it 50 cents cheaper, well, you could potentially save a couple $1 million for your investors or yourself. But when you're just trading with $5,000 here and there, timing the market really doesn't matter. So the power of contributions month over month, year over year, have an outstanding and immense impact on what your future portfolio value will look like 30, 35, 40, 50 years down the line. So I'm going to say, let's just go with our max, right? If you're able to do this, I highly recommend to everybody out there, if you can max out your Roth IRA or your traditional IRA every year, that's very powerful. So right now, I believe the limits are $6,000 a year, so which is about $500 a month. Adding length of time, I was let's say about 22 years old when I started then. So length of time 22. If I want to retire at 62, we'll just say 40 years, just to be safe. All right. Interest rate, the average annual return dating back to I think the 1930s in equity returns, full stock meaning equity or stock, is about 8% annual return. So let's just say 8. We're going to go with a 2% variance. So on some years maybe you make 10%, Other years, maybe you only make 6. Compounding, we're going to do it annually, and I'm going to calculate. So this is really powerful. So with just a $5,000 initial investment at 22 years old, in 40 years, you will have $1.66 million. And that's at an 8% return. So if you take a look here at this chart, scroll down, you take a look, again, that number after 40 years, so at 62 years old, not even full retirement age, which I believe is 66 and a half, so I could have really made it 45 years, you're at 1.66 million, okay? Let's go down here and take a look at what these three lines mean in the different colors. Red is your future value that was shown above. So your red line is what this number is. Your blue line is as if you had a 10% return every year for those 40 years, contributing the same exact amount of money, $500 a month. And the green line down here is your lower return. So let's say, you know, you're just not as risky. You have some bonds in your portfolio. You're going to have this is saying you should have about $980,000. On the high end, you would have $2.88 or $2.9 million in your portfolio. So now let's switch it up, right? So let's get a little crazy with these numbers here. Let's go 45 years, okay? So let's say now you're going to say, nah, we're going to push retirement back a little bit. I really love my job. I like working. So look at that. We'll look at what that just did. By pushing back your retirement just 5 years and continuing to add that $500 a month, your portfolio in essence grew from, what was that, 1.66 million to about 2.5 million. So you grew almost $1 million in your final 5 years of work. That's unbelievable. That's outstanding. So to get to your first million, it took you, to hit $1 million, it took you 34 years. To go from 1 million to 2.5 million, it took you 11 years, right? So here you're at year 34. See, it goes from 939, the future value in the red, to 1.02. So your 33rd to 34th year, you eclipsed the $1 million mark in your, again, this is hypothetical returns in your portfolio based on averages of historical performance. So 34 years to get to 1 million, and then 11 more years to grow another 1.5 million. That's the power of compounding growth. Again, this is without you pulling any money out of the portfolio. Everything stays in, everything gets reinvested, capital gains, dividends, interest, all that. And then let's say, you know, just for giggles here, and kind of just to mess around with this, let's say you got in late on your investment plan, right? Maybe you waited until 30 or 32 years old to start your retirement account. So you only have, let's say 32 years, right? So instead of 45, we're going to go to 32. But you're leaving everything else the same. You're going to start with $5,000. You're going to put in $500 a month on top of that. Let's calculate. So here's the difference. So instead of starting at 22 years old, you started at, let's say, 32 to 34. You know, you were late to the game. You were trying to figure things out. Maybe you didn't get the job you wanted. You weren't making the money you wanted to, and you really just didn't have the ability to save, right? You're talking about a portfolio difference, though, in size, right? In overall dollar figure value, a difference of close to $2 million, right? So you saved this person, hypothetical, we'll call him John. John saved for 32 years, but he didn't start his retirement account until he was, let's say, 33 years old. The prior example we'll say is Jim, right? Jim started at 22, saved for 45 years, so only an additional 13 years. His balance was 2.4, almost 2.5 million. This is 863,000. I don't know about you, but I would love to have an additional almost $2 million when I go to retire. $2 million. You know, you talk about a drawdown number, they say an average should be about 4 to 6% year over year in retirement. That's a lot of money. That's going to last you a long time. And if, let's say, something happens to you, you know, everybody says, oh, you know, I want to spend all my money right now. What do I need? What do I need to retire for? Right? You don't need to spend all of your money, right? If you have a good size accumulated portfolio and something happens to you, you get sick and you end up passing, well, that's money for your, you know, for your wife, or money for your husband, or money for your kids, maybe, to get them started with a better life and a better future. So you can always hand that money down. I just wanted to show you guys the power of that compounding. And then again, let's make this let's make it a little more crazy, right? So let's say you were 22 years old, right? And you were really aggressive. You were like all in on sector ETFs and individual stocks, and you're somehow getting a 12% annual return. Same numbers, $5,500 a month. You're going to invest for 45 years. Let's just take a look at what that does. So before I used an 8% estimated annual rate of return, now I bumped it up to 12%. So instead of 2.4 million, you have almost $9 million. So don't get me wrong. For anybody out there who says, oh, you know, just put money away, it doesn't matter what it's in, just put it, you know, even if you throw it into a bond index, you know, throw it into treasury bonds, you'll be fine. Well, fortunately, I don't really agree with that. You're talking about a massive difference in portfolio size. $9 million in 45 years versus 2.4. And if you went a little less, let's say a little less aggressive than that, 980,000. I mean, these are massive differences. If you're averaging a 14% return year over year, you're talking a $17 million portfolio. So don't let anybody out there tell you, oh, returns don't matter, just keep clipping money away. For any of you out there that have a financial advisor currently, or you know, are looking at your returns, I always like to look back over a 3 to 5 year period, and compare my returns to the index. If I'm not beating the S&P 500 or the NASDAQ index, I'm doing something wrong, right? That means that whatever investments I'm picking myself I'm not beating even what I could if I had just put my money in an index, closed my eyes, shut my account down, and just let it go to work on its own. So if you're somebody like that, I highly recommend, you know, if you're picking some bad stocks and some investments that aren't growing very much, why not? I would sell out, get rid of your laggards, and just buy the index, right? Go in and buy QQQ, buy VOO. They're super cheap, they're easy to invest in, and you're gonna get, you know, 6, 8, 9% return year over year for a 40-year period. If you're trying to outperform, this is your potential. You know, you could have a $9 million account if you stay very diligent in your savings and you're smart in your investment decisions. If you work with an advisor, let's say, Edward Jones, or, you know, some of these small FAs out there that really, they work at shops that, you know, just put you in random mutual funds that have really kind of below average performance, talk to them, have a conversation, give them a call, ask them, say, hey, you know, so-and-so, Steve, you know, I'd really like to see what my performance looks like compared to an index over the last 3, 5, and 10 years. If they're underperforming every year the index, maybe they're not the right advisor for you. Maybe you got to talk to them about, you know, moving some stuff around into some better investments. So that's all I wanted to talk to you guys today about. Again, click that like button, subscribe to the channel if you like what you heard today. I'm going to do a couple of more videos on this topic moving forward, how to mess around with this calculator, and really how to increase your overall potential gain in your portfolio size as you move forward on your investment journey. Again, Rational Millennial. This video is for entertainment purposes only. Thanks again for tuning in. I appreciate the time.